In this video, we delve into the critical topic of stock market crashes and their far-reaching implications for investors. Our primary purpose is to educate viewers about the nature of these downturns and the strategies that can be employed to navigate them effectively. Understanding stock market crashes is essential for anyone involved in investing, as these events can significantly impact portfolios and financial futures. By examining the dynamics of the market during these turbulent times, we aim to equip you with the knowledge necessary to make informed decisions. It's crucial to recognize that while market crashes can be alarming, they also present unique opportunities for wealth creation. Many successful investors have capitalized on downturns by identifying undervalued assets and making strategic purchases when prices are low. This video will highlight the importance of maintaining a long-term perspective and not succumbing to panic during market volatility. We will discuss historical examples of stock market crashes, analyzing their causes, and the subsequent recovery phases, which often lead to substantial gains for those who remain patient and strategic. Understanding the cyclical nature of the market can empower you to take advantage of these situations rather than fear them. We will also explore various investment strategies that can be employed during downturns, such as dollar-cost averaging, diversification, and focusing on fundamentally strong companies that are likely to rebound. By the end of this video, you will have a clearer understanding of how to approach investing during challenging times and how to position yourself for potential growth when the market eventually recovers. Engaging with the material presented will not only enhance your knowledge, but also inspire confidence in your investment decisions. Remember, while stock market crashes can be daunting, they are also a natural part of the economic cycle. And with the right strategies, they can lead to significant wealth creation. Join us as we navigate through these essential concepts, ensuring you are well prepared to face any market challenges that may arise. Stock market crashes often stem from a variety of interconnected factors, and understanding these primary reasons is crucial for investors. One significant cause is the phenomenon known as bubble bursts. A bubble occurs when asset prices inflate beyond their intrinsic value, driven by excessive speculation and investor enthusiasm. A historical example of this is the dot-com bubble of the late 1990s, where internet-based companies saw their stock prices soar to unsustainable levels. When reality set in and many of these companies failed to deliver on their promises, the market experienced a dramatic collapse, wiping out trillions in value. This illustrates how irrational exuberance can lead to devastating consequences when the bubble inevitably bursts. Another critical factor influencing stock market stability is the state of the economy and the impact of policy changes. A weak economy characterized by high unemployment rates, declining consumer spending, and reduced corporate profits can create an environment ripe for market downturns. Additionally, shifts in government policies, such as changes in interest rates or regulatory measures, can significantly affect investor sentiment and market dynamics. For instance, when central banks raise interest rates to combat inflation, borrowing costs increase, which can slow economic growth and lead to a decline in stock prices. Understanding these economic indicators and policy implications is vital for investors looking to navigate potential market crashes. Moreover, we must consider the role of black swan events, unpredictable occurrences that can have severe consequences on the market. These events, such as natural disasters, geopolitical crises, or sudden financial scandals, can shake investor confidence and lead to rapid sell-offs. The unpredictable nature of black swan events makes them particularly challenging for investors, as they can occur without warning and disrupt even the most stable markets. The 2008 financial crisis, triggered by the collapse of major financial institutions, serves as a stark reminder of how unforeseen events can lead to widespread panic and significant market declines. In summary, stock market crashes can arise from bubble bursts, economic instability, policy changes, and unpredictable black swan events. By understanding these primary reasons, investors can better prepare themselves for potential downturns and develop strategies to mitigate risks associated with market volatility. Recognizing these factors is essential for making informed investment decisions in an ever-changing financial landscape. Understanding the cyclical nature of stock market movements and crashes is essential for investors seeking to navigate the complexities of the financial landscape. Market downturns can be categorized into several types, each with distinct characteristics. Pullbacks are minor declines, typically ranging from 5% to 10%, that occur within an overall upward trend. Corrections are more pronounced, usually defined as a drop of 10% to 20% from recent highs, signaling a temporary reversal in market sentiment. Bear markets represent a more severe downturn, characterized by a decline of 20% or more, often lasting for an extended period. Finally, crashes are abrupt and dramatic declines, often triggered by panic or significant negative news, leading to a rapid loss of market value. It's important to emphasize that crashes, while alarming, are an inherent part of the investment cycle. They can present unique opportunities for savvy investors who are prepared to act when prices are low. Historically, many investors have capitalized on market downturns by purchasing undervalued assets, positioning themselves for substantial gains when the market eventually rebounds. Recognizing that these downturns are temporary can help investors maintain a long-term perspective and avoid making impulsive decisions driven by fear. To provide historical context, we can look at recovery patterns following significant market declines. For instance, after the dotcom bubble burst in the early 2000s, the market experienced a prolonged period of recovery, ultimately leading to new highs in the following years. Similarly, after the 2008 financial crisis, the market took several years to recover fully, but it eventually rebounded, reaching unprecedented levels by the end of the 2010s. These examples illustrate that while downturns can be painful, they are often followed by periods of growth and recovery. In summary, the cyclical nature of stock market movements encompasses various types of downturns, including pullbacks, corrections, bear markets, and crashes. Understanding these cycles is crucial for investors, as it allows them to recognize that crashes are not the end of the road, but rather a part of the investment journey. By maintaining a long-term perspective and being prepared to seize opportunities, during downturns, investors can navigate the complexities of the market and position themselves for future success. Capitalizing on market downturns requires a strategic approach, as many investors often make common mistakes that can hinder their financial success. One of the most prevalent errors is panic selling, where investors react emotionally to market declines by hastily liquidating their positions. This knee-jerk reaction can lead to significant losses, as selling during a downturn often means missing out on potential recovery gains when the market rebounds. Recognizing the importance of maintaining a level-headed perspective during turbulent times is crucial for long-term investment success. One effective strategy to mitigate timing risks during market downturns is dollar-cost averaging. This approach involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, investors can take advantage of lower prices during downturns, effectively lowering their average cost per share over time. This strategy not only reduces the impact of market volatility, but also encourages disciplined investing, helping to avoid the pitfalls of trying to time the market. Dollar-cost averaging allows investors to build their positions gradually, providing a buffer against the emotional stress that often accompanies market fluctuations. Another key strategy during downturns is to focus on investing in strong, profitable companies. These companies typically have solid fundamentals, including robust balance sheets, consistent cash flow, and a history of profitability. During market downturns, even fundamentally sound companies may see their stock prices decline due to broader market sentiment. This creates an opportunity for investors to acquire shares at discounted prices. By concentrating on companies with strong competitive advantages and resilient business models, investors can position themselves for significant gains when the market recovers. Additionally, diversifying investments across various sectors can help mitigate risks associated with downturns. By spreading investments across different industries, investors can reduce the impact of a downturn in any single sector. This diversification strategy can provide a more stable investment portfolio, allowing for potential growth even when certain areas of the market are struggling. In summary, to capitalize on market downturns, investors should avoid common mistakes like panic selling, embrace strategies such as dollar-cost averaging, and focus on strong, profitable companies. By adopting a disciplined and strategic approach, investors can navigate market volatility and position themselves for future success, turning downturns into opportunities for growth. During market crashes, investors face numerous pitfalls that can jeopardize their financial well-being. One of the most significant dangers is the temptation to try to time the market. Many investors believe they can predict the best moments to buy or sell based on short-term market movements. However, this approach is fraught with risk, as accurately timing the market is incredibly challenging, even for seasoned professionals. Instead of relying on speculation, it is crucial for investors to conduct thorough research and analysis. Understanding market fundamentals, economic indicators, and the specific factors driving stock prices can provide valuable insights that lead to more informed investment decisions. Relying on research rather than attempting to time the market can help investors avoid costly mistakes during volatile periods. Another common pitfall is the inclination to buy low-quality stocks simply because they appear cheap. During market downturns, many stocks experience significant price declines, which can create the illusion of a bargain. However, not all discounted stocks are good investments. Some may be fundamentally weak companies facing serious challenges that could hinder their recovery. Investing in low-quality stocks can lead to further losses, as these companies may struggle to regain their footing even when the market rebounds. It is essential for investors to focus on the underlying fundamentals of a company, assessing its financial health, competitive position, and growth potential before making investment decisions, rather than solely considering the price. Additionally, diversification across sectors is a critical strategy to protect against market volatility. Concentrating investments in a single sector can expose investors to heightened risks, especially during downturns when specific industries may be disproportionately affected. By diversifying their portfolios across various sectors, investors can mitigate the impact of poor performance in any one area. This strategy not only helps to spread risk, but also increases the likelihood of capturing gains from sectors that may perform well, even during challenging economic conditions. In summary, investors should steer clear of several pitfalls during market crashes, including the dangers of trying to time the market, the risks associated with buying low-quality stocks, and the importance of diversification. By focusing on research, maintaining a disciplined investment approach, and diversifying their portfolios, investors can navigate market volatility more effectively and position themselves for long-term success. As we wrap up our discussion on navigating market crashes, it's essential to recap the key points we've covered. First and foremost, staying calm and informed during these turbulent times is crucial for investors. Panic can lead to hasty decisions that may result in significant financial losses. By maintaining a level-headed approach and relying on research, you can make more informed choices that align with your long-term investment goals. Remember, market downturns are a natural part of the investment cycle, and understanding this can help you remain composed when faced with volatility. We also highlighted that historical patterns suggest recovery is likely after downturns, while it may be challenging to see the light at the end of the tunnel during a crash. History has shown us that markets tend to rebound over time. By focusing on strong, fundamentally sound companies and employing strategies like dollar-cost averaging, you can position yourself to benefit from the eventual recovery. This perspective can transform a potentially stressful situation into an opportunity for growth and wealth creation. Moreover, we discussed the importance of avoiding common pitfalls, such as trying to time the market or investing in low-quality stocks simply because they appear cheap. Instead, diversifying your portfolio across various sectors can provide a buffer against market volatility, helping to protect your investments during downturns. By adhering to these principles, you can navigate market challenges more effectively and enhance your chances of long-term success. We encourage you to engage with this content further. If you found this video helpful, please consider subscribing to our channel for more investment insights and strategies. Your support not only helps us grow, but also ensures you stay updated on the latest trends and tips in the world of investing. Additionally, liking and sharing this video with friends or fellow investors can help spread valuable knowledge and foster informed discussions within your community. In conclusion, remember that staying calm, informed, and strategic during market crashes is key to navigating these challenges successfully. By applying the insights shared in this video, you can better prepare yourself for future market fluctuations and seize opportunities for growth. Thank you for watching, and we look forward to seeing you in our next video.